When central banks raise interest rates, it's significant news. The bank is assessing that the sole method to combat inflation is to continue increasing interest rates. We will witness higher rates, resulting in elevated borrowing costs. This action can have far-reaching consequences on the entire economy, potentially impacting consumers' confidence. Employment rates, wages, and stock prices. If interest rates rise excessively and rapidly, it can even push economies into recession. Therefore, the question arises, why do central banks choose to raise interest rates? Let's start with the basics. If you borrow money, you'll have to repay a little extra to make it worthwhile for the lender. Well, I think we can assure you that as long as you have a good reputation and are reliable, it will work out. I'm glad you think so. This is the interest rate. So, when taking out a loan, you prefer a low interest rates to minimize the repayment amount. On the flip side, if you want to save money, a high interest rate allows you to earn more on your savings. Consider it as a reward for keeping your money in your account. However, the magnitude of this reward depends on these circumstances. In the economy, there isn't a single interest rate. There are thousands of banks setting their own commercial rates. These rates are influenced by the interest rates set by the central bank. A central bank functions as a bank for banks, just like you have a savings account. Banks also earn interest when they keep money with a central bank. Commercial banks hold reserves, which are like their cash on hand. They lend these excess reserves to each other at an interest rate and can also deposit them with the central bank to earn interest. Ordinary people can't access the interest rate on these excess services and reserves, but it still affects them. And that's the concept. When central bank raise interest rates, they aim to control inflation, the speed at which prices rise for everyone. For example, if inflation was 1.29% and now it's 1.39% in just 4 weeks, central banks like the Fed, the Bank of England, and the European Central Bank strive to achieve an inflation target of 2%. Interest rates are a powerful tool they use to achieve this. If inflation is deemed too high, central banks raise interest rates. This change spread through the financial system, showing down the rate of inflation. Here's how it works. When a central bank increases interest rates, commercial banks earn more on their reserves. They might prefer to keep their money in the central bank rather than lending it out. If they do lend, they raise their interest rates to make it worthwhile. How this affects consumers depend on the economy. Let's consider mortgages. In countries like Finland and Australia, many people have mortgages with valuable interest rates. If you have a valuable rate mortgage linked to the central bank's interest rate, higher rates immediately translate into less available cash for other expenses. Less disposable income leads to reduced household spending, and businesses become cautious about raising prices, ultimately lowering inflation. In other countries like the United States or Canada, a larger proportion of mortgages have fixed rates. People with fixed rates are shielded from the direct effects of an interest rate increase, but they still experience an indirect impact. Higher interest rates makes mortgages more expensive, which can cause house prices to fall if affecting new buyers. This can make home owners feel less wealthy, prompting them to spend less. Lower spending contributes to lower inflation. It's not just consumers who tighten their purse strings. Businesses find it more expensive to borrow and invest when interest rates rise. This generally leads to decreased economic activity and may result in fewer job opportunities. Lower jobs and wages means less money for households, further impacting consumer confidence and reducing spending. Individuals may also experience a decline in real wages, meaning their money buys less. When interest rates rise, it tends to slow down spending, investment, and overall economic activity. As a result, businesses become hesitant to raise prices, which helps curb inflation. It sounds straightforward, right? However, the challenge lies in determining how far to go. In 1981, the Federal Reserve, America's central bank, allowed interest rates to soar to a staggering 19%. While this move curbed inflation, it caused widespread economic hardship. In conclusion, the decision by central banks to raise interest rates is a crucial tool in their efforts to control inflation and stabilize the economy. While it can have significant impacts on borrowing cost, consumer spending, business investments, and overall economic activity, central banks believe that the short-term pain is worth it to maintain low and steady inflation in the long run. Finding the right balance and timing for interest rate adjustments is a challenging task, as central banks must navigate the complex dynamics of inflation, employment, and consumer behavior. Nonetheless, interest rates remains a key instrument for central banks to manage and shape the overall health of the economy. Like and subscribe for more videos like this. Thanks for watching. See you next time.